A company just locked in a game-changing partnership with a fintech unicorn, plugging its technology into a platform that moves over $3 billion every single year. Then it approves a monster $300 million share buyback program. Then management doubles down, reiterating a target of $360 million in revenue by 2026. By every conventional rule of finance, this stock should be blasting straight to the moon. So why on earth is it doing the exact opposite? Why is it aggressively bleeding out, trapped in one of the most brutal downward fades on the market right now? And here's the part almost nobody is talking about. More than 34% of this stock's entire float is sold short. Do you have any idea what happens when a third of a company gets shorted this heavily and even one piece of good news actually sticks? We're talking about the raw ingredients for a violent, explosive short squeeze. So what exactly is the market seeing that all these glowing press releases are conveniently leaving out? If you're the kind of investor who loves finding these hidden asymmetric setups before the crowd catches on, do me one quick favor and smash that like button and subscribe. It genuinely helps this channel more than you know, and it keeps breakdowns like this one coming your way. All right, let's get into it. That whole setup sounds wildly contradictory, doesn't it? A company doing everything right while its stock does everything wrong. But it all starts to make sense the moment you look at what's actually happening underneath the hood. Let's start with the catalyst that, on paper, should have sent this thing flying. Rezolve AI recently announced they are embedding their agentic commerce infrastructure directly into Zilch. And I want to be crystal clear here because this matters. This isn't some basic vendor agreement. This isn't a flashy little pilot program designed to grab a headline and fade away. This integrates their technology directly into a financial environment with nearly 6 million customers and $3.3 billion in annual merchant flow. Think about what that actually means from a business model perspective. In theory, this transitions Rezolve from being just another standalone AI startup fighting for attention into a foundational infrastructure layer operating at massive scale. That is a completely different kind of company. So why isn't the market rewarding it? And here's what makes it even more intriguing. If you track where the capital is actually flowing, it becomes crystal clear that the smart money is paying extremely close attention to this exact pivot. Institutional ownership currently sits at nearly 28%, and the major players are actively loading up. JP Chase just boosted its holdings by over 120%. SBI Securities aggressively scaled up their position by 271%. But here's where the timeline gets genuinely fascinating, and honestly, a little bit suspicious in the best possible way. Exactly one day before the Zilch partnership went public, an individual investor named Alejandro Gonzalez disclosed a massive 7.5% passive stake in the company. That's over 30 million shares. Now ask yourself something. What are the odds that someone accumulates that enormous a position right at the bottom one single day before a market-moving announcement, purely by coincidence? That kind of perfectly timed accumulation tells you there is serious underlying confidence happening quietly behind the scenes. So if the smart money is buying, why is the price still collapsing? Well, before you get too bullish and rush to slam that buy button, there's another critical layer to this story. And this one right here explains the crashing stock price better than anything else. Here's the massive, undeniable anchor dragging this stock straight down. Valuation. Rezolve AI is currently trading at a price-to-sales multiple of 20.5 times. Now, let me give you some context so that number actually lands. The average multiple for the broader US software industry is hovering around just 3.5 times. Let that sink in for a second. This stock is priced for absolute flawless textbook perfection in a market that is deeply, ruthlessly unforgiving of even the smallest mistake. And it gets tighter. Their current and quick ratios sit at just 0.67, which points to some very real short-term liquidity constraints. So in plain English, they are burning through cash, and yet they are being priced like an established mega-cap tech darling. Do you see the tension building here? Can a company this early really live up to a valuation that's demanding? And that fundamental stretch is violently reflecting in the technical data. Structurally, this stock is heavily bearish right now, and there's no sugarcoating it. It is trapped well below both its 200-day moving average of $2.73 and its 50-day moving average of $2.62. The market is essentially standing there, shrugging its shoulders, and fading every single piece of good news that comes out. Trend followers and algorithmic traders take one look at this chart and they don't see a bargain. They see a broken asset. But is it really broken? Or is this exactly the kind of setup where the biggest opportunities hide? Here's where the story gets a whole lot more complicated, because all of this weakness has quietly created a highly volatile powder keg. And this is the part you cannot afford to miss. Look at the short interest. A staggering 34.15% of the public float, that's nearly 36 million shares, is currently sold short against this company. And with a days to cover ratio of 2.6, this stock is a coiled spring wound, tighter and tighter with every passing session. Now let me explain why this is such a big deal. When over a third of a stock's float is shorted, those sellers eventually have to buy the stock back to close out their positions. They have no choice. So imagine what happens if Rezolve suddenly announces real commercial traction or a massive volume spike rips through the tape. Those short sellers get forced to buy at market price, which pushes the price higher, which forces even more of them to buy, which pushes it higher still. It's a vicious self-feeding cycle of relentless buying pressure. This extreme positioning could violently ignite a massive short squeeze, and the only question left is, what pulls the trigger? And we can actually see the trenches of this exact battle being dug right now in real time in the derivatives market. Looking at the options chain for the end of July, there is a massive wall of resistance sitting at the $2.50 strike with incredibly heavy put and call open interest facing off directly against each other. Meanwhile, down below, a psychological floor is being fiercely defended near the $2 mark, backed by heavy call volume. So understand what you're really looking at here. This isn't some sleepy, casually traded stock drifting along on autopilot. This is an active, heavily contested battleground between retail bulls, institutional buyers, and aggressive short sellers, all fighting over the same few strike prices. Which side do you think blinks first? So the real question becomes, how does an analytical trader actually approach a setup this chaotic without getting completely torched? Let's break down the numbers. If you are approaching this from a short-term speculative perspective, there is a genuinely asymmetric long setup sitting right here. And I mean asymmetric in the sense that the potential reward dramatically outweighs the clearly defined risk. Because of that enormous short float, the recent aggressive institutional accumulation, and the structural floor theoretically provided by that $300 million buyback mandate, the risk-to-reward ratio is remarkably clean. The accumulation zone sits between $2.15 and $2.25, sitting just slightly above the 52-week low. Your hard stop loss is $2.05, and this part is non-negotiable. If it decisively breaks below that 52-week low, the setup is technically broken, and the stock falls into the abyss with essentially no historical support beneath it. But, and this is the exciting part, if that line holds firm, the initial short-term target is $2.62, lining up perfectly with that 50-day moving average. And if the shorts get squeezed and that $2.50 options wall finally shatters, the price action to the upside could be downright explosive. So could this be one of those rare setups where the floor is defined but the ceiling is wide open? And that brings us to the one question long-term investors actually lose sleep over. Forget the short-term trade for a moment. What is this company actually fundamentally worth? Because Wall Street is completely hopelessly fractured on this one. On one side, you have a consensus of 7 analysts practically screaming moderate buy with an incredibly aggressive $11 price target. Simply Wall Street models fair value at $10.75 based on assumptions of massive revenue growth ahead. But then, on the complete opposite end of the spectrum, you have Weiss Ratings issuing a flat-out, no-nonsense sell. How can two professional analysts look at the exact same company and land light years apart? What does one side see that the other is completely missing? The reason for this stark, polarizing divergence comes down to one single monumental metric, and it isn't complicated. It's execution. That crushing weight of the 20.5 times valuation is colliding head-on with the promise of their $360 million full-year 2026 revenue target. And here's the cold, hard truth of today's market. It does not care about AI buzzwords anymore. It does not care about slick press releases or ambitious roadmaps. The market is now demanding to see whether these enterprise pilots, like the ones with Zilch and Tata Consultancy Services, can actually be converted into scaled, booked, recurring revenue. That's the whole ball game. The current bearish price action is simply the market aggressively pricing in the very real risk that management might fail to deliver on these enormous promises. So the question that hangs over everything is this: can they actually execute in time? Which means over the next few quarters, this entire thing comes down to a race against the clock. And there are two specific things you need to obsessively monitor from here on out. First, the cash burn. Remember that 0.67 current ratio. That means management has to meticulously navigate around a short-term liquidity crisis before these massive partnerships have enough time to actually scale up and start generating real cash. It's a tightrope walk. Second, keep your eyes locked on the share repurchase execution. Management needs to actually deploy that $300 million buyback authorization. And here's a little insider wisdom for you. Announcing a buyback is easy. Any company can put out that headline, but actually spending the capital, that signals deep, genuine internal conviction that the stock is truly undervalued. So will they put their money where their mouth is? Which leads us straight to our final verdict on Rezolve AI. Before we get there, a quick and important note. Everything you've heard in this video is for educational and informational purposes only. It is not financial advice. I am not a licensed financial advisor, and nothing here should be taken as a recommendation to buy or sell any security. Stocks like this one carry significant risk, and prices can move dramatically in either direction. Always do your own thorough research and consider speaking with a qualified financial professional before making any investment decision. Your money, your responsibility. All right, so let's bring it all home. Ultimately, this leaves us staring at two completely distinct realities. In the short term, Rezolve AI presents a highly compelling, though undeniably speculative long setup, fueled by that extreme short interest and the flawlessly timed institutional buying. It's a calculated risk with a clearly defined floor at $2.05. But in the long term, the entire thesis hinges on one word and one word only: execution. If Rezolve can monetize the Zilch ecosystem fast enough, the upside from these levels is absolutely tremendous. But if they stumble, if they delay, they will be crushed under the immense weight of their own valuation multiple. This is a stock of high conviction and extreme, undeniable volatility, all rolled into one. So now I want to hear from you. If you had to choose right now, would you bet on the short squeeze igniting from these oversold levels? Or do you think the crushing valuation drags this one down before management ever gets the chance to execute? Drop your take in the comments below, because I read every single one and I genuinely want to know where you stand on this. And if this deep dive brought you real value today, do me that one favor, hit the like button, subscribe to the channel, and turn on notifications so you never miss the next breakdown. Thanks so much for watching, and I'll catch you in the next one.